Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, March 24th, 5 o'clock Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Daily Market Insight video, where we take a look back at the prior week, take a look ahead at what's important to know for next week, and update the world famous 21 over 21 leaders list. Let's dive right into it. State of the market, we're in a correction. Tech rally underway. Tech continues to be strong, along with, and by tech, really, we mean the FANG stocks, semiconductors, select software stocks are holding up okay, as well as gold and silver stocks acting well. But if you've been paying attention at all, you know there's been a lot of drama in the market with the banking crisis, the banking liquidity crisis. We added another name to that this morning, but stocks shook it off, and we'll get into that momentarily. Let's take a look over here at the trend gauge. Leadership, neutral. I'm being pessimistic when I say neutral. Leaders are continuing to act well, so I've got the optimistic green arrow under that. Let's suffice to say that leaders are ready if the market wants to participate. There are a lot of great looking stocks with great fundamentals that are set up. A lot of them have had decent runs, but the market overall is treating them like basketballs being held underwater. The market is a weight around their ankle. I don't know how many cliches I can use, but uh, stocks ready to roll if the market is ready to participate. And really, what we need is this banking crisis shadow lifted from over the market. So let's take a look at the five major indexes which we track across three time frames. This and the action of leading stocks dictates our exposure to the market. So we're in a downtrend on the short-term time frame. That's the 21-day moving average. Nasdaq 100 uh, has been bucking the trend of the rest of the market, which is way down with financials, oils, and some other underperforming sectors. But the Nasdaq 100 is green across all three time frames. So we did short-term, medium-term, same thing. We use the 50-day moving average for that, 21-day exponential for the short term, long term, the 200-day moving average. S&P undercut and reclaimed it this week. Nasdaq 100 firmly above it. The others battling with the 200-day moving average. So we've got a neutral there. So what happened today? I'm calling this the "It Didn't Feel Like a Green Week" edition because with the casino-like action after Powell spoke on Thursday after the FOMC decision, and then Thursday, and then add in Janet Yellen's contradictory statements to that. Thursday and Friday were like a casino. Today, a drama-free positive close to the week. It didn't start out drama-free with, we'll talk about Deutsche Bank when we get to the tail of the tape, but very nice close to the week. Uh, Believe it or not, 10 of the 11 S&P sectors closed positive, including financials and including the KRE and KBE. Those are the regional bank and banking indexes. Amazingly, they closed green for the week. So the charts don't lie. Price is truth. Think what you may, but they're trying to put in a bottom despite a lot of negative attention and negative news being paid to them. So here are the final numbers. We're rechristening the G6 as the G7, the RG7, Revere Growth 7. We added the large cap component of the S&P 600, large cap component. We added the growth component of the S&P 600 small cap index as our seventh ETF to this. And a couple of reasons for this. One, it shouldn't be ignored. And two, adding another index weighs down the weight of ARK-K. ARK-K can be so unwieldy and move contrary to what's going on with the other six that sometimes it doesn't give a clear picture with the return, what's actually going on. So we added a seventh, and it's now the RG7. If you want the full list, it is IWO, that's the Russell 2000 growth component. FFTY, that's the IBD 50. QQQJ, that's the mid cap NASDAQ 100 tech. PDP, which is a Dorsey Wright momentum index, ARK-K, MDYG, which is the growth component of the mid cap 400, and now SLYG, that is the growth component of the S&P 600. So G7 it is, up 0.13% on the day. S&P up 0.56, closed at the high of the day after gapping down. Nasdaq 100 0.37, nice close after lagging all day long, weighed down by a rare weak day from semiconductors. Dow up 0.4, mid caps up 0.74, Russell 2000 up 0.85. When I put up the weekly charts and saw that these actually finished positive for the week, I was kind of taken aback, but then I looked back, understood, and remembered that Monday and Tuesday were strong days going into the FOMC, despite all the drama that we saw uh, Wednesday and Thursday. Global Diversified 60/40 closed Friday up 0.18%. In-house GROTECTION up 0.06%. We'll get to the tail of the tape in the updated 21 over 21 list as we get into things. And let's start off with, as we always do, a chart of the S&P 500. And you can see here, undercut reclaim of the 21. That's the green line, and the black line, that's the 200-day moving average. So why do we pay so much attention to these? Well, these are the three time frames that we use as part of our system to dictate exposure. We look at the indexes and how they're acting, and then we also look at how leaders are acting. Lately, there's been a lot of focus on semiconductors and tech in general, and that's where we've been focused. And we pay so much attention to the 200-day moving average because, of course, of this chart here, the last 13 bear markets. All of these occur under the 200-day moving average. So normally, if you're in a quote unquote normal market, I know we've got to go back quite a way to a normal market, but you normally top about 12% above the 200-day moving average. For the 2022 bear, we topped about 9% above. And this recent pullback below the 200, we topped about 6% above. So it's what happens when you get below the 200 that you have to be concerned about. Last year, January to October, the drawdown was 27.5%. The COVID drawdown, very quick, very harsh, down 35.4%. December 2018, down 20%. Sometimes they're bad, sometimes they're not, but you always take a decent amount of time to get back above to reclaim the losses. And if you're approaching retirement, you don't always necessarily have time for this. I have a lot of people say, well, we came back nice after COVID. Well, what if we didn't? What if the death toll was 4% instead of 0.01%? You just never know. You get out of the way when you're below the 200-day moving average and let the smoke clear. And then if you protect the downside, the upside will take care of itself when the market gets back to healthy. And if you're interested in this approach, reach out to us. That's Don at revereasset.com, or my partner, Danny Stewart, Dan at revereasset.com, or the phone is 855 Real Wealth. That's 855-732-5932. Here's your chart of the S&P 500. Let's go to a 5-minute chart. And here's the casino-like action I was talking about. Uh, Sometimes it's just a phrase. Sometimes it's somebody contradicting what you're saying that causes the market to panic. So Jay Powell saying there aren't going to be any interest rate cuts in 2023, despite the market pricing them in, led to the first part of the drop. And then Yellen at the same time saying, and I'm not going to imitate her. If you want my Yellen impression, go ahead back and listen to Thursday night's video. But she said, we're not entertaining any deposit support at this time. So follow through to the next day. We had a gap up, cooler heads prevailed. Nice run all the way up to 4,007. And then that's it, topped. Trend down and then accelerate when she's testifying on Capitol Hill. But then she says, well, we'll consider taking action if it's warranted. And then down 1%, up 1%, down 1%, up 1%. This is casino action. We've got no edge there. We got rid of our indexes and our semiconductor long when that happened. And then today, gap down on Deutsche Bank. The price of credit default swaps for Deutsche Bank just shot up overnight in Europe. The Deutsche Bank stock sold off. That uh, looked like it was possibly going to be another panic, but cooler heads prevailed. We put in a bottom within the first 30 minutes, and then we just trended higher. And by trend, I mean higher highs and higher lows all day. Up and down, it's choppy. Then it tightened up in the afternoon, but every time we made a higher high, we pulled back and made a higher low. Great close to the week. And here you can see the week up 1.4%, trapped among a bunch of weekly moving averages. But as I said, leaders are ready for a breakout if we can clear the banking situation and credit doesn't freeze up. Powell indicated that the tightening of the credit markets was going to act like an additional interest rate raise. So the odds are right now over 90% that we're not going to have another interest rate increase at the next Fed meeting. And we'll see how the markets respond and how the economy responds to that. So there's the S&P 500. Let's go to the Nasdaq 100, the leading index. Uh, Two failed breakouts, one after Powell, another one on Thursday. Uh, the late afternoon drama led us to take off the last of our QLD. This still looks fine, but we had nice profits, didn't want to see the market split wide open overnight and have it go down and give up some good gains. So we locked them in, kept all our stocks, added to a few positions today, started one new position. This looks fantastic. Nice, tight, uh, flat base, 21%. No, it's not 21%. It's 9% deep. Come on, just give me the daily. All right, trust me, it's 9% deep. And this little handle, we kind of needed that after coming straight up off the bottom. So good day for a rest today. And semiconductors rested too, SOXX. Rare underperforming day. We took advantage of that to get back into NVIDIA. Let's go to the Dow Jones Industrial Average. Uh, Closed high of the day, didn't undercut last week, so that's a plus. Still under the 200-day moving average. Mid caps, MDY, undercut today. So as for right now, we've got an undercut and a reclaim. In other words, a shakeout. Anybody that had stops under the lows of the last week got shaken out today, and this is basically makes it a false breakdown from this structure. Every bottom, not every bottoms frequently start with a shakeout like this. Doesn't always have to be um, massive volume, but for now it puts a line in the sand. And if you go to the weekly chart, I didn't believe it, but mid caps were up 1.24 percent on the week. And then let's go to IWM, up 1/3% for the week. Go to the daily chart, another undercut of this 170 area from back in December and last week. We undercut it yesterday. We made another low today, but finished at the top of the range. So trying to put in a bottom. Let's go to KRE and KBE. KRE made a new low, closed at the high of the day. That's regional banks. KBE made another low, closed at the high of the day, undercut the lows of the prior week, trying to put in a bottom. Here's the weekly chart on KBE. It did indeed finish positive, and until I was reviewing the charts, I wouldn't have believed this. KRE, same thing, undercut last week, closed inside of it. No guarantees, but it gives us a reference point and a starting point, which is what we're looking for to make money in the market. So those are the five major index and the banking indexes. Let's take a look at the dollar UUP. It was strong today after 2 weekdays after the Fed, a gap up. It's oversold today. It wasn't a headwind for stocks. It was a headwind for gold and silver, which had been acting well. We'll look at those charts in a minute. After we look at the VIX down today, uh, trading in the last 3 days, 4 days in this 20% range between 20 and 25. Trying to put in a bottom, but wary of a spike as always, depending on any news that came out. But shaking off the Deutsche Bank news this morning and closing at the lows of the day, while the index is closed at the highs of the day, is a good sign for bulls. Let's go to junk bonds. Junk bonds down just a tad today. Broad bond index BND up. Bonds kind of traded in a tight range today after the last 4 days. Higher bond price means lower yield across the board. Uh, LQD investment grade corporate bonds, higher price, lower yield, TLT, the 30-year, higher price, lower yield, really a tight range over the last 2 weeks for TLT. But let's take a look at something interesting here. Here's the TYX, first of all, the 30-year yield. It did not make a lower low, bounced at the 200-day moving average, kind of a tight range today. But look at TNX, the 10-year. Made a lower low, finished near the high of the range. This looks like first of all the second candle in a Morningstar pattern. A Morningstar pattern is when you go lower and you kind of wash out, put in a bottom, close at the high in the second candle. The third candle confirms it if you close more than 50% into candle number one, which was yesterday. So for now, this looks like a possible washout in yields. Again, it's a reference point. We just go by the candle combination and what the charts tell us. And it's consistent with some of the things we saw on other charts. So for right now, it's possible that yields have bottomed, which they've bottomed not because of anything that the Fed is doing. They've bottomed because of people rushing into buy bonds as a fear trade. So that's bonds. Let's go to gold and silver first. The stocks. GDX had a nice day today, higher high as they continue off of the lows. GLD, a little bit of a pullback, 1% today. Uh, silver also pulling back. Not a surprise since the dollar was stronger today. Bitcoin down 2.3% today, taking a little bit of a break. Okay, so those are the major indexes that we check. Let's now go to the tail of the tape. You can freeze this. I'll hit the highlights. Um, the big highlight is we really aren't in bull or bear, which is why we've got correction and tech rally, but we're certainly ready. Decent close to the week. The news was the gap down on, as I said, Deutsche Bank credit default swaps, which means you make money if Deutsche Bank defaults on bonds. Uh, there were some bigger banks came out saying there really didn't appear to be any reason for this. It was overblown. That calmed the market a little bit, but whatever. We were down much more into the close, and the losses faded as we got to the open, and we ended up opening instead of down 1%, only down 0.4%. And as I said, we put in the lows early in the day, and then higher highs and higher lows all day into the close, which was a good thing. Durable goods were below expectations. That's something the Fed would like to see. PMI was above expectations. That's something the Fed would not like to see. Day count, we went from flat to up 1, and our first close on the S&P back above the 80 EMA and the 21 EMA. Expectations got better, reclaiming the 200-day moving average and the 21. Only one close above the 21. We need to see a second one to establish any kind of a trend. And the levels above the 221, as I said, we're in this resistant range on the NASDAQ 100. Here's the action on the day. Here are the sectors. Gold stocks, banks, and value stocks did well today. Staples, utilities, um, healthcare, and real estate on the downside. Gold and silver, semiconductors, and solar stocks. The only one of the sectors and well, let's get to the bottom line. Drama-free Friday, thankfully. All 5 indexes in 10 of the 11 sectors closed the week positive. The only sector that was negative on the week was utilities. Here's our focus list. This is basically what we own. We added to NVIDIA today. So basically selling NVIDIA, and then it pulled back below where we sold today. So it's kind of gave us a kind of like a credit, and we use that credit to get into NVIDIA. We bought it a little bit extended, bought 2 1% positions, but uh, even if we get stopped out, it won't make up for, it will be less than what we saved by getting out where we did yesterday on SOXL with the pullback today. And then we added First Solar, which continued to act well. Upped our exposure, all stocks and GLD. So 8 positions, 1, 2, 3, 4, 5, 6, 7, 8, and GLD, all between a little over 1 and 4%, over 4% now because of the returns on ON. Our adjusted beta 0.59. So basically, even with a 60-40 portfolio, we've got 40% in T-bills, short-term T-bills, Not 59% cash. We've got about less than 20% cash put in, but it's the volatility of what we own. We do this calculation, volatility adjusted beta, to tell us where we stand relative to the market. This is much over one when the market is strong, and we give every stock a grade. Uh, I've talked about that in a couple of different videos. So as I said, bottom line, drama-free Friday, all 5 indexes in 10 of 11 sectors closed the week positive. Let's get to the 21 over 21 now, and we'll start off with the stocks that got booted out. And really, nothing significantly wrong with the ones that got booted out, but um, we needed some room to add a couple of them. And so what got booted out was Melly, just really not outperforming since it had its earnings gap. You can see the last 3 weeks, no relative strength. Did bounce off the 50-day moving average today. So not bad, but not great. And we also got rid of OKTA. A couple reasons. One, we own Pan W. It's in here and it's acting well. It's acting better than this. And if we had to have another one in this week, Fortinet, FTNT, is acting better than uh, OKTA is. But we wanted to add ELF back because ELF had a breakout today above this tight range that it's had, above average volume today. So we wanted to get ELF back in here. So this is our newest addition, ELF. And then also this week we added Tesla since we bought it with a move above the 21. It's pulled back on lighter volume, sitting basically right above the 21. So we think that's a good look. This is ready to blast above the 200-day moving average in this 217.65 area. The 200-day is now below that. So yeah, it's double area of resistance, but if the market's strong, Tesla has a lot going for it. And if it breaks above that area, we've got a starter, and we would add more to it. So the rest of these are carries overs from last week. ON, great reaction to earnings on Tuesday, day 4 higher high. This is basically a model of gap up stocks. I've talked several times this week about the webinar on Sunday that I'll be attending with John Pocoroba, that he's Rain King on Twitter, and Jason Thompson from Ticker Monkey at TCM LLC on Twitter. If you need any more information on that, well worth it. It's amazing some of the studies and stats that these guys have put together to give you confidence for buying these monster gaps. And very often you see these monster gaps are the beginning of huge runs in stocks. There's no guarantees, but there's a lot of precedence on footwear stocks just acting fantastic. Crocs back in 2007, you got LA Gear, you got Reebok. Nike's been a big winner. So yeah, they're trendy for now, but these trends persist for a while and you can make a lot of money in it. Based on historical precedents and the action of the stock. So ON, our biggest position right now and our biggest gainer. Moving on, GLD, gold, continues to act great since it broke out of that big cup and handle. AMD, we own this. As always, if it's flagged, we own it. These should be sorted. It doesn't matter. We'll go through the ones we own first. AMD, if it's red flagged, we own it. Continues to act well. I skipped over this right here. First Solar pulling back nicely and then bounced at the 21 after its earnings gap up. Palo Alto acted great, pulled back again to the 21. This familiar action with these gap stocks when they report good, better than expected earnings and they have the gap. That's institutions tripping all over themselves to get shares that they know they need but don't have. Arista Networks, one of the strongest stocks in the market, continuing closing near all recent highs. Nvidia, again, one of the top 5 stocks in the market. We took advantage of this pullback today, just brute strength, and it's positioned great for the AI revolution that's going on. There's ELF. CDNS acting fine. Hey, once again, earnings gap up, pulled back, held to 21, putting in a little flag here. PagerDuty, earnings gap up, flagging nicely. BJ's sitting right on the 21. Wingstop acting very nicely, reasserting itself over the last 2 weeks. Meta, another earnings gap. Uh, Very nice flat base, under accumulation sitting near the top of that range. GE Healthcare continues to act fantastic, bouncing off the 21 this week. Axon at the 21. Four, that's shift four payments. I'm giving this one the benefit of the doubt. It's basically a tenth of a percent below, but it checked a lot of the boxes from this gap study that I've been reviewing. So I'm keeping it on here to make sure I keep a close eye on it. Lantheus, great action after recent earnings and then an upgrade. Made it break out of the little handle after its earnings report. ALGM continues to hold up well. ACLS continues to act up well. And General Electric, surprisingly, on here for a while. But hey, these are gross stock type numbers with a 94% increase in earnings for 2024. And that's your updated 21 over 21 list. And that's going to wrap it. So remember, it's not how much you make in the market, it's how much you keep. We got defensive this week when we saw some uh, like I said, casino-like action. Don't want the market to split wide open on banking sector fears or something that happens overnight. So there's times to be very aggressive and there's times not to be. This is a time not to be, but we'll get more aggressive if the market rights itself and cooperates. And if you have any questions, feel free to reach out to me, Don at RevereAsset.com. The phone is 855 Real Wealth. It's 855-732-5932. So wrapping up the week ending March 24th. This is Don Vandenbord. Just the facts here at Revere. The fact is that 10 out of 11 sectors closed positive, plus the two banking sectors, plus all five indexes after some really harsh action after the FOMC. We'll see what next week brings. We're ready for anything. Thanks for listening and have a great weekend.